Assalamualaikum warahmatullahi wabarakatuh. So today my groupmates and I will be presenting on the topic that is given to us, which is clubs. So I'm going to explain on the definition of club. A club is formed not for commercial purposes, but for social, recreational, sports, arts, science, literature, or other leisure pursuits for the interest and benefit of their members. Examples of such clubs include an athletic club, an antique car collectors club, and a historical society. Club and societies are not defined in the Act. It is defined in the case Kowloon Stock Exchange Ltd versus CIR 1985 to mean an association formed for other than business purpose. It should not exist for the financial advantage of its members. A club is registered under Society Act 1966. For the purpose of income tax, club is deemed to be a body of persons. Now I'm going to explain the tax treatment for clubs. A club is normally set up to service its members, and such may rely on the principle of mutuality for tax exemption. Prior to the year of assessment 2009, there was no specific provision on the tax treatment of a club, association, or similar institution. A club has been subject to tax based on the two general taxation principles. First, members' fee and income from transactions with members are not subject to tax based on the principle of mutuality. And second, income derived from transactions with non-members is subjected to tax. Members, which is the person who are entitled to vote at the general meeting of the club, where effective control is exercised over its affairs, while non-members are the person who are not entitled to vote in the meeting. When trading with non-members occurs, the principle of mutuality no longer applies, and exposure to tax can arise on any surplus that may occur. Some clubs do activities like trade dealings, such as a fitness center or a professional football club, which is conducted for a profit. These activities will be subject to tax as business profits. Transactions with members are not considered as trade dealings. Any surplus of receipts over expenditure in respect of income from transaction with members must be used for the benefit of all the members of the club, whether to buy new equipment or to pay for special occasions open only to membership. However, when a club, association, or similar institution provides its facilities such as restaurant or golf course to non-members on a commercial basis, it is deemed to be carrying on a trade, and therefore the income from the trading with non-members is taxable.
The principle of mutuality and the accessibility of receipt are crucial concepts in the taxation of clubs and societies. The principle of mutuality states that a member cannot profit from trading with themselves. In the context of clubs and societies, this means that any contribution or discretion made by members are exempted from tax. The rationale is that the clubs is essentially a collective of its members, and any surplus generated from members' contribution over expenditure is not considered income for tax purpose. However, this principle only applies to transactions between members. When a club engages in trading activities with non-members, the principle of mutuality does not apply. In such case, any surplus generated from this transaction is subjected to taxation as it is treated as business income. Accessibility of receipt. According to the transaction rules, any income that arises from transaction with members is not taxable under the Act. This means that clubs do not have to pay tax on income derived from their members, such as membership fee or contribution. Additionally, any expenses or capital allowance related to this income are discarded for tax purpose. On the other hand, income generated from transactions with non-members are treated differently. Such income is considered accessible and is subjected to taxation. Clubs must maintain separate accounts for income derived from members and non-members to ensure proper tax treatment. In summary, the principle of mutuality allows clubs to operate without tax liability on members-related income, while income from non-members' transaction is taxable, reflecting to clubs' business activities. Next, sources of income members and non-members. Income from members is include interest fees and subscription received from members, provision or services to members for a fee, and sale of goods to members. For income from non-members is business income, include fundraising activities or events open to the public. Rental received from hiring out the club hall, facilities and equipment to the public. Amount paid by non-members to attend dinner or social functions, also to attend talk, presentation, workshop, and last proceed for non-members on charitable event. Then, income from member and non-member. Trading activities such as restaurant, bar, entertainment outlets, gymnasium, massage center, yoga, selling beverage, souvenir, and proceeds received from vending machine derived from member and non-member within the club premise are profit in nature and subjected to tax. The dealing with members and non-members are two distinct business sources. Revenue and spend that are directly related to either members or non-members are deducted fully from that sources. Revenue and spend incurred in generating income from both member and non-member would be, however, apportionate using gross income basis. These expenses are known as common expense.
Today, I will be discussing how income from investments and external sources is treated for tax purposes. First, income from investments such as interest, rent, and dividends is taxable if it is non-mutual income. This means any earnings from investments outside of a mutual arrangement are subjected to tax. Second, let's talk about clubs, associations, or similar institutions that may have external parties providing services on their premises. For example, these external parties might install vending machines, run restaurants or bars, provide catering services, operate gyms, or even offer entertainment. The income paid to the club or association by the external party for using their premises is considered income from external sources, not from their own members or non-members. As a result, the income is fully taxable to the club, association, or similar institution as it is derived from external business activities, not from internal membership fees or donation. Now, I will explain how revenue expenses and capital allowances are restricted when calculating income for clubs. This is particularly important when dealing with income from non-members. First, the amount of revenue expenses to be restricted. To calculate the amount of revenue expenses to be restricted, we will use this formula: A times B over C. The amount of A is the total common revenue expenses such as administrative costs or salaries. For the B, it stands for the gross income from non-members transactions. For the C is the total gross income including the both members and the non-members transaction. For number 2 is capital allowance restriction. Similarly, the capital allowance is to be restricted is calculated using this formula: D times B over C. For D is the total common capital allowance. B is the gross income from non-members. For the C is the total gross income from both members and non-members. In both formulas, the key is to allocate the common expenses or allowances proportionally to the income from non-members. This ensures only non-member related to the costs are used in the taxable income calculation. I will explain on how cash donations under Section 44, subsection 6 will be calculated. Cash donation made to the approved institution or organizations can get a deduction up to 10% of the aggregate income. The amount of the donation that qualifies for the deduction is calculated using this formula: G times H over I. G stands for the total cash donation under Section 44, subsection 6. For the H, aggregate income for non-members. For the I is the total aggregate income for members and non-members. This ensures that the deduction is proportionate to the non-member income in the club's total income. Next.
For the computation of the tax of club, since any income from members are non-taxable, but not all transactions from members not subject to tax, because not all transactions are involving members are necessarily mutually received. We will compute with the section 4 subsection A business income for the club first, and minus with all direct expense, common expense, and capital allowance. For the common expenses and capital allowance must be apportionment based on gross income basis. After that, we have to add all income from section 4 subsection C in interest and dividend if any, section 4 subsection D rent and rental if any, to get aggregate income. For approved donation, we have to minus an apportionment based on aggregate income basis. Then will we get chargeable income? The calculation on tax must be used rate or scale of tax. Club is not eligible for any personal release that are applicable to individuals when computing the chargeable income. If the club compute aggregate income from members and non-members, and the club found any losses transaction with member, the losses cannot be deducted against income arising from transaction with non-members. For the exemption, state clubs are affiliated to the Olympic Council of Malaysia may apply for exemption provided under Para 26 Schedule 6 is income of any national amateur sport organisation certified by the President and Secretary of the Olympic Council of Malaysia to be affiliated that council during the basis year for any year assessment, and any state amateur sport organisation certificate the President and Secretary of an organisation to which Para A apply to be affiliated to that organisation during the basis year or any